So I wanted to talk today a little bit more about common mistakes that are made, the psychology in trading, and really how to focus your attention into the most important aspects of trading. And I really believe that there's one factor, only one, that differentiates the profitable trader from the unprofitable trader. And it comes back to psychology. It comes back to the way that you handle the markets. So, yes, understanding technical analysis can be helpful. Yes, understanding the fundamentals of the market can be helpful. But people put too much attention on that, and they don't understand that really the way to make money is to make the hard decisions. It's to do the hard things. It's to, take the trades that everybody else feels afraid of that are working. And so it's, having a game plan. It's all these things that we're going to talk about today. And we want to help you to avoid those common mistakes. So first mistake, trading without a plan. If there's one thing that we want you to do, it's to put things down in a plan to help you protect yourself from yourself, right? So we're going to talk a lot about psychology today, the psychology of the markets that causes you to make bad decisions at the wrong times. Well, if you'll put it in your trading plan, you can put protective measures in there. In essence, you can put in protective measures like, well, here's how I'm going to use my stop losses. Here's when I'm going to raise a stop loss. Here's how I'm going to handle the markets. So it basically defines every aspect of your trade so that your emotions don't get you in trouble, right? And we'll talk about what some of those mistakes are that cause your emotions to get you in trouble, such as forming an opinion. And more than forming an opinion, it's okay to have an opinion, but people get locked into that opinion. I've seen this happen literally hundreds of times. I used to work on Wall Street, and I've worked with traders from a risk management standpoint, and I've always noticed that when they're losing money, they try to find justification for their actions. So they buy, let's say, a stock. They'll go and try and find data points. If it's going against them, they'll try and find justification for staying in the trade. Well, Kramer likes it. Well, it's a great American business. Well, it pays a dividend. They'll just make up excuses for staying in it. Whereas if the trade was working, they'd have sold it a long time ago. And kind of a funny story on this point, I used to work with a trader, and he would get into a position and he'd be like, we'd be talking on the phone and he'd say, I really think their China sales are going to be robust, and they've got huge growth potential for the next 3 or 4 years. And then you'd hear ding, and he sold the position. Why'd he sell it? Because it went a little bit up. And I'm like, your reasoning for buying this were all long dated, all long term. Oh, it's got great fundamentals. It's going to set the world on fire. And you sold it 15 minutes later because it spiked in your favor. You see how that is illogical, right? It just doesn't make sense. So don't get locked into an opinion, and then also consider whether that opinion even matters for the time frame you're trading. Poor risk management will destroy you. Position sizing, buying the right amount, not risking too much of your capital per trade, critical. Cutting profits short and letting losers run. This is, again, the one factor that I always come back to. It always comes back to, essentially, people letting their losses get too big and cutting their winners too small. And that's why everything that we talk about really comes back to this one point. That everything you do, if you don't have a plan, then emotionally you're just going to sell your profits too quick and you're going to hold your losers too long. It's been proven. If you form an opinion that you can't get away from, that now it's personal, now it's a part of you. You are bearish on the market and it keeps going up. Now you take it personally. You can't change your opinion. Well, you're going to let those losers pile up. Poor risk management, position sizing, you're going to take too big a loss when you let those losers run. So impatience, another common mistake, not waiting for the right setups. Fearful reactions to short-term moves. There's a difference between a trending move and choppy trading. We need to be able to identify the differences. Unrealistic expectations, feeling like, well, I'm going to start with $1,000 and I'm going to turn it into $1,000,000 overnight. No, that's not going to happen. You're going to have to turn that into $1,000,000 over time. Lack of diversification, so make sure that you're not all piled into the same positions and in all of your capital. So if everything you have is shorting the euro, there's no real diversification there. You have everything on the same trade essentially. Trading against the trend, so many people want to predict trend changes. They want to predict when markets are turning, and they lose sight of the fact that, working with the trend, being on the side of the trend will pay off more times than trying to bet against it. It's the easier trade to take. There's just no doubt about that. Timing tops and bottoms, same thing. Trying to pick the tops and the bottoms is trading against the trend. Focusing too much on being right. It's not about being right, it's about making money. And that comes back to being able to get away from opinions you have. The most stubborn individuals that have to be right every time, they're horrible traders because they get caught into this trap of holding their losers because they think they need to prove this right over time. And eventually they'll get annihilated. So how do we overcome that? Well, a man should never be ashamed to say he's been wrong, which is but saying, in other words, that he is wiser today than he was yesterday. If you take 100 trades, how are you possibly going to believe that you're going to be right on every single one of those? That every one is going to be a perfect entry point and so on and so forth? You're not going to be. Just like if you start 100 businesses, not all of them are going to work out. Which ones do you want to keep? If you start 100 new businesses, you want to keep the profitable ones and shut down the businesses that are unprofitable. It's pretty obvious, right? We want the ones that are growing, expanding, that are showing promise. The ones that just aren't working, people don't want it, they don't want that product, whatever it is, we shut those businesses down. And trading's the same way. If I take 100 trades and let's say that 60 of them start off with a profit, 40 of them start off with a loss, I'd much rather dump the losers and try to cultivate and grow those winners. How illogical would it be? I call it cutting your flowers and growing your weeds. How illogical would it be for you to walk outside your front door with a pair of scissors and you go over there and you walk to the flowers and you just start cutting them up? And then you just let the weeds grow and grow and grow. Why? Because you took it personal that the weeds didn't go away on their own. That's kind of trading with bad positions. You're holding on to your weeds. And if you have a good trade and you hurry and sell it too quickly, you're just cutting off your flowers before they bloom. And so changing that mindset is the entire focus of this class. So how do we overcome it? Beware of your tendencies, your habits, and your biases. I promise you that 99% of you at least have these tendencies, these habits, and these biases because you're a human being. So it's possible that some of you don't have these tendencies, but it's very unlikely. It is just human nature, and that's okay. We're all built with these tendencies, these habits, and these biases, so we all have to do the same things to overcome them, which starts with developing a strong trading plan and then morphs into following that plan. You have to follow the rules you set. If you don't do that, well, then your plan can't protect you. If you follow the plan, then it will protect you from yourself. So here's a trading plan example, kind of template. Depending on your time frame, your goals, you might have 3 to 4 different rules for each strategy that you're going to trade, but it's just important to understand and recognize how to do this and then go and create your own plan. A trading plan should have certain criteria. It should have detailed out what strategies you're going to be utilizing. So I'm just calling this long FX. You're going to buy an FX trade. Well, it could be a swing, an intermediate, a long term. It could be hopefully working with the trend when you're going long and so forth. But let's talk about this a little bit more in depth. In some of our educational classes, we teach actual strategies, how to buy on a pullback, how to use our Bollinger Bands criteria, how to buy on a breakout. These are all strategies. Well, let's put one in here. We're going to call it a high base breakout is the strategy. Okay. Now, when I trade a high base breakout, it could be on a couple of different time frames. I could be using an hourly chart, which means essentially that I'm a day trader in the FX markets. Not because I'm going to sell it 15 minutes later, but on an hourly chart, I'm probably projecting to be in the trade for, the next 4 or 5 hours. Sometimes it'll last 1 or 2 or 3 days, but for the most part, it's short term. Okay? What if I was using a daily chart? Well, then I'm a swing trader. What does that mean? That I'm going to be in the trade for a few days. What if I was using a long-term weekly chart? Then I'm going to plan to be in it for a few weeks, right? And you're going to signal, you're going to have different time frames. You're going to know based on that time frame how you want to trade it and what your goals and your risk and your position sizing will be. Well, what is a high base breakout? Basically, the chart pattern looks like this. It's just simply, I'll jump back a page. High base breakout is, let's say the stock is in an upward trend and then it forms a sideways base. It's simply a pattern and a strategy where you would buy on the breakout to new highs. So here's your sideways base in an uptrend, and where's your buy point? Our buy point is we want to get in if we break above resistance, right? So we have a trading plan. Now again, I'm not dictating what time frame this is. Maybe this is happening on an hourly chart. Well, if it's happening on the hourly chart, I'm now trading that time frame. So let's say that the currency does in fact come up here. I would have a game plan. In my trading plan, I know how to buy on that breakout. So I'd have what we call a buy stop order. A buy stop order is an order to buy above resistance. So I'm going to buy this currency. Maybe resistance is at 110. I put my buy order up there at 110.08. So that's where I buy in. Then I'm going to have a protective stop. Maybe my protective stop goes below this prior little swing low. Or maybe even it goes below the base or what have you. Well, that's my protection. So then I have a sell stop order. This means if the trade's not working, kick me out of it. Maybe this is down at 109.32. Okay? Now I know my risk. Once you know your risk in a trade, you can really determine a lot of factors. You know how to position this trade. You know in this case you have the difference between those two numbers is 76 pips. So that's how much you're risking. Okay, well, I know now how to kind of position this trade. I know that I'm risking 76 pips. So I know that if I buy, let's say, a full lot position, again, something we teach in our educational classes on position sizing and risk management, and we teach it in all of our videos on 7minutefx.com. Now I know how to position size. I know how much risk I have in this position if I buy a mini lot, if I buy a micro lot, if I buy a full lot position in the FX markets. And then I might have a target, and again, we teach this in our class. So here we have the basing pattern. This is the size of the base. We can project the same distance on the upside. So this is called a measured move. We're simply measuring the size of this base and projecting that the breakout will make an equal sized move on the upside. Well, maybe the size of that base was about 150 pips. So we're calling our target up here. We'll call our target price 150 pips above 110, which would put it up there at 111.50. So what's our potential reward? Well, the difference between your target and your entry price is your reward, just as the difference between your entry price and your stop loss is your potential risk. So 111.50 minus our entry price of 110.08 is 142 pips. So our reward potential is 0.0142. Notice our reward is basically twice our risk. Is that a good trade setup? Absolutely. We have a 2-to-1 reward to risk ratio. We're perfectly comfortable with the idea that sometimes this trade will not work, but sometimes it will. And if this trade were to work 40% of the time, let's say it had a 40% success rate, 4 times out of 10, you'd make a ton of money because you're making twice what you're risking. So if you are risking $100, but you could make $200, if it works 4 times at $200 a piece, you have 800 in profits. It doesn't work 6 times at 100 loss, that's 600 in losses. Every 10 trades, you'd make $200 total. I'm just throwing out a number just so you can see the math behind it. That with even just a 40% success rate, you can make a lot of money. And if you trade around a strategy like this, don't you believe that your probability of success will increase? I certainly do. So in terms of trading, a great example of how we can take something like a trading template like this, build out strategies, criteria, working with the trend. We can have goals for how much money we're going to make over periods of time. We would have risk parameters. I already talked about this, not risking too much of any of your portfolio in any single trade. We can calculate our risk, the difference between our entry and our stop. We can talk about what our entry rules are, our exiting rules, when we would remove stop losses and so forth, what our routine is. We can talk about daily, weekly, and monthly analysis that we're going to do. We can have all of these things laid out in our trading plan. Now, is this something that you can develop instantly in the next 10 minutes? Of course not. It's going to be something that you're going to develop over time. You're going to take it piece by piece. And in all of our educational classes, we teach every one of these processes. So as you come into the education, you learn more about strategy. We teach the high base breakout. We teach buying on the pullbacks. We teach the Bollinger Band. We teach you strategy. And then you're going to apply each of these principles to that. We teach you how to calculate position sizes. We teach you processes behind routines. In our educational classes, we talk about grading different currency pairs, anywhere from -3, which is the most bearish, to +3, which would be the most bullish. So a lot of this process, again, you're going to develop as you learn the FX markets. Set goals for each new strategy. How you effectively learn the market is with hopefully paper trading at first and then live trading when you feel comfortable. So what's your start date? What's your completion date? The date you first put real money for a strategy. Set goals for when you're going to go live, when you're going to have your trading plan complete, when you're going to, have made your first $1,000 in profit. Set achievable goals and then work towards them. A goal that's not written down is simply just a wish and it's not going anywhere. So, really set some defined goals. Set some goals of what you'd like to accomplish. The final thought in this class that I want to go through is actual problems that people have with trading, the psychology of it. Again, recognizing how your mind works and then understanding how you can improve upon that is critical to long-term trading success. So there are negative habits such as framing, anchoring, confirmation bias. These are formed early in a trading career and can be detrimental to you. A lot of people will become jaded and they'll say, the market's rigged or it's out to get you. It's not logical. Just please understand that, let's take an FX market example. In the FX markets, there's trillions of dollars of value. If you think that they can move the US dollar exchange rate 1% just to wipe out your tiny little trade, it's so illogical, it's not even worth talking about really. So please understand that, when you place a trade in the equity markets, they're not moving the S&P 500 1% just so they can wipe you out. It doesn't happen that way, okay? You're not big enough for them to worry about, and they just don't really care where your trades are at from that standpoint. So the market is absolutely not out to get you. The bad news is that you're out to get yourself. Your mind is the problem, and it's negative habits inside of your mind that are causing these issues. I want to talk about these three, and then hopefully by recognizing, I think some of you are going to have some of those aha moments where you go, holy smokes, I've seen this. I know exactly what he's talking about. I've made these mistakes, and now you'll be able to overcome them. So let's first talk about framing. How do you decide which pair to buy? How do you decide the best time to buy? And once you've made the decision to buy, when are you going to sell? These questions and how you answer them are a direct result of how you frame the question, thus directly impacting your trading performance. And worst case scenario is some people don't even ask the questions. They just go on a whim, which is absolutely the worst idea. If you're buying things from a gut instinct perspective, you think you can just go out and kind of guess the markets better than everyone else. I call it people thinking that they can panic better than everyone else. I've never seen anyone make money ever because they could just simply panic better. Everybody that I've ever known in the financial markets has some sort of game plan, and they have framed the questions the right way. Think about what we just discussed with our trading plan. We framed which pair we're going to buy. We're going to buy the one that's in a nice bullish pattern. We framed how and when we're going to buy, when it breaks through resistance of this nice high base pattern. And then we discussed when we're going to sell. Either A, it falls to the stop loss, or B, it rises to the target. We framed these questions to create a nice risk to reward. If you don't frame them in that way, then essentially you're buying blind and you're selling blind. And I promise you, as I've said a number of times already, you're instinctively going to hold your losers and cut your winners. You're instinctively going to cut your flowers down and let your weeds grow. So please frame these questions and then build around that. Framing determines the viewpoint from which we look at an issue, such as a chart. In essence, framing acts as a filter determining what information is important and what is not important. If we have not created a frame, or if the frame is constantly changing to satisfy current emotional imbalances, then our performance will suffer accordingly. I've noticed that traders will go through different emotional imbalances, and some of it's life. The worst idea I've ever heard of is to trade when you're emotionally checked out. So if you're on vacation, if you're moving, if you're going through a divorce, these are all periods that are very detrimental because in some cases, well, let's use the most extreme example, going through a divorce, you're actually in an emotional state that has way too many highs and lows in that type of scenario. And oddly enough, there have been numerous examples where people have, in essence, kind of sabotaged themselves to to almost make themselves feel worse during this period of time. So trust me when I say that emotionally, you're going to go through ups and downs in your life. You're going to have positive and negative, emotional responses. Some days you come in and you slept well and you're just in a cheery mood. Well, you're gonna make trading decisions based on that mood that are different than the next day when you didn't sleep at all, you're grumpy, you're hungry, and now you're going to make trading decisions in that state of mind. This is why, again, trading around a framework is so important. If you simply are trading technical patterns based on risk to reward, it doesn't matter your emotional imbalances because it's just a framework you're working off of, right? It's like going to your job and your job is to, do something on a conveyor belt, okay? Well, it's just a system. So it probably doesn't matter that much what your emotional state is because you simply have your job laid out for you and you do it almost without thinking, right? Which in the financial markets is a protective measure to keep you protected from yourself. Let's talk about anchoring. Similar to how a house should be built upon a good, solid foundation, our ideas and opinions should also be based on relevant and correct facts in order to be considered valid. This is not always so. The concept of anchoring draws on the tendency to attach or to anchor our thoughts to a reference point, even though it might not have any logical relevance to the decision at hand. So, in other words, we anchor to some piece of information that we deem to be relevant, which in fact may not be relevant at all. It may seem like an unlikely phenomenon, but anchoring is fairly prevalent in situations where people are dealing with concepts that are new or novel. So a lot of people, look at the last 7 years. The stock market has boomed higher and people have bet against it every step of the way. They've been pessimistic. They've blamed the Federal Reserve. They've made excuses. They've done this. They've done that. They're anchoring to things that just simply aren't valid. The market's going up because people are buying, because capital's out there. And in fact, if you are going to do something with the Fed, you should be giving the credit to the Fed. You should say the Fed is inducing this rally. Let me jump on. Let me get on board. But people anchor to certain opinions that maybe aren't relevant. Let's do an example. Anchoring can be a source of frustration in the financial world as investors base their decisions on irrelevant figures and statistics. For example, some investors invest in pairs or in companies that have fallen considerably in a short period of time. The investor is anchoring to a recent high point that pair, that currency pair, or that stock has achieved, and now they believe that the drop has provided a great buying opportunity. While it's true that there is fickleness in the market and a move down could be a buying opportunity, a sharp move lower is not a recipe for good buying. In fact, it's the exact opposite. When something is falling sharply, it usually perpetuates more selling. The probability of that asset going lower increases in part because there's what we call margin calls. There's forced liquidations that take place in the markets. So to think that something that's spiked down sharply in the short term will bounce back sharply is just not logical. In fact, usually it has to work off over time that drop, and then it can start to have a sharp rally down the road, much later than most people anticipate. It could take, in other words, a few months to work off a short-term sharp decline. You don't have a multiple months to wait. You're going to get stopped out before that. So sometimes people think that a sharp decline creates value. That's not necessarily the case. For example, let's say that you bought a stock that had great revenues, right? The revenues were just robust. The stock price goes from $25 per share up to 80. Now, the same thing can be true in the FX markets, causing a currency pair to go up. But I'm just using a stock example because it's easy to understand. Stock goes up because the company's making more money. But then the company's major customer, who contributed 50% of the revenues, decides not to renew. This could be Apple, an Apple supplier, maybe a supplier of their semiconductors or something like that. Anyway, their chips, Apple decides not to renew. Well, that's a huge drop in their business. So the share price drops from 80 to 40. Should you instantly buy? Well, no. There's a loss of value within the business. The stock price dropping doesn't necessarily create value if the business is getting worse. Most people, literally, when they first start in the financial markets, they look for the weakest components and then they try to buy them, thinking that somehow they're buying the weakness and it's going to instantly go back up as a trade. While that could work if you knew how to do fundamentals and found value and had a long-term time horizon, as a trader, there's what we call momentum, and it's probably the most important factor to making money. Buy things that are going up. Now, the US dollar is not a great example of this because last week it was the strongest and this week it's the weakest. That was due to news from the Fed and Janet Yellen. Well, sometimes you'll get whipsawed in a trade. Sometimes what was the strongest becomes the weakest. That'll happen from time to time, but just believe me when I say that most of the time what's the strongest becomes the strongest, and good times beget higher prices. When a company starts to lose revenues, when a currency starts to break sharply lower, as we say, selling begets more selling. Sometimes it's forced liquidations. It could be a lot of different reasons, but momentum matters in the financial markets. By anchoring to a prior high point of 80 and thinking that the current price of 40 is value, they're anchoring to the wrong thing. They think that the company is a great value simply because the share price has gone down. The company is not valuable because its share price has gone down. A company is valuable because it's a great business, because it's going to bring in more revenues, more earnings, more, capital, etc. Keep in mind that XYZ is not being sold at a discount. Instead, the drop in share price is equal to the loss of revenue from that big customer. So there's no more value in this because it lost business. In this example, the investor has fallen prey to the dangers of anchoring by anchoring to just a share price moving and thinking there's value in that, which does not create that value. Finally, there's what we call confirmation bias, also called my side bias. Confirmation bias is a tendency for people to go out and favor or try to find information that confirms their preconceptions or their hypothesis. Regardless of whether the information is relevant, true, or whatever, they try to find the evidence and they try to find something that supports their thesis, right? So if you buy a currency pair and it starts to trade against you, most people go and try and find reasons to stick with it. They say, well, but it's, this central bank is doing this, or they go and try and find reports that tell them, yeah, this is going to go back up, figuring that, well, somebody else likes it somewhere, somebody thinks it's going up, let's go find those people. And then they just found the information they were searching for. Trust me when I say you can find somebody that has the same opinion as you. That doesn't make it right. In fact, the only thing that matters is whether you're making money or not. I mean, if you want to really simplify the markets, you're getting right and wrong answers instantly. If you buy something and you start to make money, you're getting the right answer. If you start to lose money, you're getting the wrong answer. Now, you could go hand in your work and just keep handing in the wrong answer and hope that one day it magically gets you an A, but it's probably not going to work that way. Your teacher is going to tell you this is the wrong answer. Find the right one. If you keep handing in the right answers, you're going to get an A. Okay? So don't be caught in this trap of, trying to find information that just supports your thesis. Look at it evenly, openly, and ultimately build a strategy that protects you from keeping these bad trades. Don't selectively pull from memory your biased preconceptions. Instead, again, find information that is valid and that will create profitability. The biases appear in particular for emotionally significant issues and for established beliefs. And there's no more emotionally charged issue than money. Money brings out emotions you maybe never thought you had. You will try and find reasons and justifications for different things, but as I said before, it's most important that you're really focused in on what really is most impactful to the markets. What really matters is whether you're making money or not. And so I would always emphasize to anyone that listens, it's as simple as this. When I take 10 trades, I love all of them. That's why I took them, right? I'm not going to take a trade I don't think is going to work. But out of those 10 trades, some of them are terrible, right? And I need to just wipe them out. And some of them are great. And that's what I need to cultivate. That's what I need to capitalize on. So if you take 10 trades and let's say 5 go in the wrong direction, 5 go in the right direction, if you simply will dump the losers and hold the winners, not all 5 of the winners are going to explode in your favor, but you're going to have 1 or 2 of them that make a move that's so strong in your favor that maybe the gain from just that 1 or 2, quite frankly, can make more money than what you lost in the other 5. Not to mention making some profits in the other 3 or 4 that weren't huge gainers, but still made you a little bit of money. That's ultimately trading in a nutshell. In fact, you can think of it as the bell curve. The bell curve tells you that 68% of your trades are going to be within one standard deviation, meaning they'll go up a little or they'll go down a little. But it also tells you that you have 16% that have the potential to be a disaster, and you have 16% of all trades that have the potential of being home runs. Your job is to get rid of the potential disasters, to cut them off before that ever becomes a possibility. The other part of your job is to profit from the 16% or 1.5 out of 10 trades that are going to be home runs. That is trading in a nutshell. That's statistics. There's no arguing the statistics of it. That's the way it works. And so if you will simply manage your money appropriately, cutting your losers and grow your winners, you will make a lot of money in the financial markets. The statistics basically guarantee it. I hope you've enjoyed this. As always, we try to give you as much information as possible in these classes, really give you some things to think about today. So thanks again, everyone. We'll see you next time. Goodbye.